Welcome to Daybreak Australia. I'm Paul Allen in Sydney. We're counting down to Asia's major market opens.
I'm Annabelle Droulers in Hong Kong. The top stories this hour. A stock rebound set to extend into Asia as investors hope strong earnings can quell worries over geopolitics and high interest rates. Treasuries waver ahead of a flurry of bond auctions.
ByteDance digging in for a legal battle over US moves to force a TikTok sale. The case shaping up as a test of resolve for officials in Washington and Beijing.
Plus, how Tesla's China price cuts could wipe out its entire operating profit in the world's biggest EV market.
All right, right out of the gate, we've got some breaking news for you out of Australia. It is due to bank PMIs. It's a partial reading for the month of April, and we're seeing a modest improvement here in the composite number, 53.6. That's from the 53.3 that we had back in March. A reasonable rebound in manufacturing as well, 49.9, just a shade below that crucial 50 level. And the PMI services to read, that's backing off a bit, but still in positive territory, 54.2. We are, of course, counting down to the major data event of the week here in Australia. That's going to be Wednesday's first quarter CPI numbers. They're seen holding steady at 3.4, but some encouraging partial readings there from those Judo Bank PMIs. Let's take a look at how we're shaping up in terms of trading for this Tuesday in the Asia Pacific. As you can see there, we've got futures pointing higher by about 0.25% for Australia. We did have a broad-based rally on the ASX on Monday, up 1%. Pretty much every sector, apart from energy, was in positive territory. And it was a similar story for the Nikkei and the Kospi as well. The Kospi was almost up by about 1.5%. We might see a bit more of the same today. Nikkei futures looking kind of flat at the moment. New Zealand showing a little bit of softness, off by 0.25%. But it was a pretty good day for equities in the US. We'll get to that in a moment. But we're going to have a bit of data out later as well. PMIs for Japan, watching out for those. CPI for Singapore for the month of March, that's coming up too. And of course, there's going to be a flood of earnings out of the US, Annabelle.
Yeah, that's right. I mean, as you said, we did see US stocks turning a little bit higher overnight, but the sustainability of the rebound, that's really the key question here. You've got US futures just coming online this morning, fairly flat. In fact, a little movement across the screen overall, but it is that countdown to key numbers that are coming out. The Magnificent Seven, very much in focus. We've got key numbers from that group of stocks, and the expectations as well extremely high because our Bloomberg intelligence team seeing around a 40% jump in earnings growth. So whether they can deliver on that, that's really the key question, and strategists are very much split on the expectations for numbers. Bonds-wise, we actually saw them falling. Oil as well, sort of slipping a little bit high this morning, but slipping overnight. It does seem that the geopolitical tensions, Middle Eastern risks, they do seem a little bit contained for now. And Paul, that's certainly playing into the dynamics that we see not just for crude, but also gold in turn.
Yeah, and our next guest is cautious on both crude prices and gold as well. So let's discuss this some more with Chris Weston, head of research at Pepperstone Group. Chris, I'm just wondering if your position on oil and gold is informed by that sort of easing of the geopolitical tension we've seen in the Middle East, or is it something else? Is it maybe a supply and demand dynamic that you're looking at?
Well, I think in terms of the gold one, I mean, it's obviously had a significant run, but 22% in recent months. And, some of the optionality had got a little bit too stretched. We'd seen, in very, very short dated calls, 1 week calls in gold trading about a 3-vol premium to puts. That's sort of traditionally been a level where sentiment had got a little bit stretched. A lot of this, the correlation we've been seeing in gold had to do with what we've been seeing in crude. And of course, so people have been using this as predominantly as a portfolio hedge against geopolitical headlines. It does seem now that Israel are firmly focusing their attention on Hamas as opposed to sort of Iran and the broader region. So I think people are seeing a very high probability now that this is going to be contained, and we're just rolling off a few of those geopolitical hedges. I think there's probably some further downside scope just from a positioning perspective to get down into, say, 22.60, where I think, you probably offer a chance to flip the positions and look to go long. But, it's a very extended geopolitical hedge that's coming through in markets. We've seen that in managed money, optionality, as I say. I think there's a little bit more downside there. yeah, the crude price, if we look at that, I mean, we traded from $91 down to 85.70 or so, just holding the 50-day in Brent. And yeah, if you look at two-term premiums, they've sort of moved in alignment. And yeah, I just feel there's probably a little bit more downside there, but certainly gold, I'd be looking for a better bid to come through back in a sort of 22.60.
Okay, so does this mean you're looking at opportunities in equities, and I'm thinking particularly, as Bell was mentioning, we are counting down to some pretty big earnings in the US. Are you changing some of your positions ahead of that, especially in some of those big tech names?
Not at the moment. I don't think we're out of the woods just yet. If we have a look at the price action in S&P futures, for example, and Nasdaq futures, S&P futures, we traded down to the 50-day, 100-day, bounced off that, but we just couldn't quite close above the Friday high, and that would have been a sort of a signal for me that we could probably see further positioning coming through. Obviously Tesla's very much in the doghouse on 7 days in a row. I feel people are just going to be selling into any kind of strength there. Nvidia is trading a little bit better. Yeah, obviously Microsoft's going to be a really important one later in the week. But yeah, I just think the price action at the moment is pretty unconvincing at this stage. And I think sentiment has got a little bit beaten up. We've been oversold. But I was hoping for a little bit more of a bounce from some of the risk assets to give me that sort of buy signal. It hasn't happened. So yeah, just still a little bit cautious. And I still feel people are probably going to sell into this rally in the short term.
I really like that turn of phrase there, Tesla in the doghouse. Well, that's absolutely true when you look at the stock slide this year. But what will come out of the earnings call to make you turn a little bit more positive, do you think? Well,
I'm going to be looked at. So I'm going to be following the price action. If you start seeing some volume coming back into the name, then we can look at looking for a counter move, and perhaps some of the shorts that have been coming in there can push us higher, and that's what I'll be looking at. And obviously looking at the volume, I don't think we've ever seen a situation where the stock's down 8 days in a row. We've had 4 other occasions where it's been down 7 days in a row, and each time it's snapped back. But obviously we haven't had this prior to earnings. So that's the key point of differential. And sentiment towards Tesla and the whole EV space is shot to pieces at the moment. So I think there's opportunities in EV names, but probably not so much in Tesla at the moment. People are looking at those deliveries, the reasons why. Some people bought into Elon Musk's reasons recently, but I think when they cut 10% of their workforce, I think most people now realise that this is actually a demand story and not just a supply issue that's coming through. And so I feel there's a lot to play out in the stock, and there's still some downside in the price. So I think any kind of short covering rally from this, is an opportunity to look to get short into this. I think there's still a lot more negativity to play out in the stock.
And Nvidia, as you mentioned, another key earnings, and really we've seen so much sort of a focus on that and concentration risk perhaps in the market. But what price action are you also going to be monitoring there?
Well, I think the problem with Nvidia, I mean, they don't report until May, but yeah, we need to get that back above $800, and then you start seeing the optionality coming through. The short gamma positions from dealers that they have to hedge when the price goes up, and obviously that means buying the underlying, which just perpetuates the price. We haven't seen that dynamic, and it just works as really well as just a pure momentum beast. And momentum, as you know, as a style and a factor, is underperforming at the moment. People want quality. Defensive areas of the markets have been outperforming, and I still feel like that's a place that I think a lot of people are wanting to gravitate towards. And until we see momentum showing momentum, then I think Nvidia is that trading vehicle. It just needs some more buying to come through. It needs to sort of trend a little bit higher. The rate of change to move higher, and then I think you can use it as a momentum vehicle, similar to what you'd see in something like a Bitcoin, for example. Everyone starts chasing it higher, but the natural catalyst for Nvidia from the earnings call isn't going to come for some time, and so obviously watching the chips, watching the semis, they've been trading poorly, but I think we need that momentum to come in there, and then I think you can start chasing it again.
You mentioned Bitcoin, and we just had the halving, of course, taking place. It seems to have gone off without a hitch mostly, but post-halving, it does seem like the token is lacking a big narrative, perhaps. What are you watching with that cryptocurrency in particular?
Well, it's a slow-moving ship. Obviously, everyone's done the numbers, and we all know that Bitcoin's price in the 3 prior halvings didn't do a huge amount over the month afterwards, and that a lot of supply does come out of the market. and we know that that's the issue. But of course, we've got to focus on demand. I think in the short term, we will chase the price if it starts going higher. I think a lot of FOMO capital comes in. But I think, we're watching these ETF fund flows really very, very, very sharply. And there's been a decent correlation between the performance of Bitcoin and the percentage of inflows that you're seeing into the 10 ETF flows. Grayscale, which has obviously seen some big outflows. But I think on Friday we did see a little bit of buying, coming back into the ETF. We'll be watching that one very closely. If we do start seeing fund flows coming through, then I think this idea of demand picking up again could be quite an interesting one. So while supply does come out of the Bitcoin scene, the ecosystem, certainly from the miners, it's the demand side of the equation, which I think really we've got to be focused on. What's going to be the big kicker from that? I think in the short term, it's going to be around the ETF fund flows that I think are driving that price action. But I'm encouraged by what I've seen in the last sort of 48 hours, and I've also been quite encouraged by what I've seen from the Bitcoin miners, who obviously are a negative affected by the rewards that they're going to get, the Bitcoin subsidy. And if you have a look at the price action overnight, Riot's absolutely smashed it last night, about 20%. The whole mining scene, the listed miners had well over 6 to double-digit percentage moves. So pretty encouraged by what I saw there as well.
Yeah, that question of whether we're going to see Bitcoin mining consolidation. But that was Chris Weston, head of research at Pepperstone Group. Thanks to you very much for your time this morning. And as we were discussing with Chris there, the big focus on Tesla numbers set to report first quarter earnings later Tuesday. Investors really watching margins, guidance as well. JL Warren Capital shares their outlook amid an EV price war later in the hour. But first, TikTok bracing for a court battle as US lawmakers move closer to a sale or ban order for the Chinese-owned app. Details next. This is Bloomberg.
Earnings season is here.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on Nvidia. A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
TikTok's Chinese parent company ByteDance has made it clear it has no intention of selling the short video app. That's as the US government moves ahead with its threat to shut down the platform if it's not divested. For more, let's bring in tech reporter Alex Barinka. And Alex, TikTok has a lot of reasons to fight, but also it's made it clear that it is not going to be backing down quietly.
Absolutely. And this bill is looking like it's inevitable that it becomes law. The Senate is meant to take up this bill as soon as tomorrow, but certainly this week. President Joe Biden said he would sign it into law as soon as it passes both chambers. So the fast track to reality of TikTok facing this divestiture ban legislation is here. Now, ByteDance, TikTok's Chinese parent company, the company that the U.S. government has taken issue with, has also expected that it's going to fight this tooth and nail through the U.S. legal system. If this bill goes into law with the current language, ByteDance would have 9 months with a potential 3-month extension to divest the app. But that seems to be an action that would be the case of last resort for ByteDance, who does intend to draw this out and wage a legal battle that could last more than a year, according to people familiar with the matter.
Alex, what's the plan here? Is it to weather the storm and hope for a better administration somewhere down the track? And also, in terms of what's worse, is it a ban or is it divestment?
Well, if you do the math here on that timeline that they would have, let's say it passes this week, then that would put us right around January, which is inauguration time here in the U.S., as it is a presidential election year. So certainly we've seen TikTok in the past try to kind of lean into the idea of patience and looking for a more amenable administration. Donald Trump has changed his tune on TikTok. The man who was the first president to try to ban the app by executive order is now saying that it should in fact stay here in the U.S. So at the moment, if this bill does get signed into law, which Bloomberg Intelligence puts at a 90% chance of happening, then that might be their best recourse, is wait for an administration, if Donald Trump gets voted in, who is either going to drag out enforcement or might be a little bit more amenable while they do try to fight this on both First Amendment arguments and otherwise in the American judicial system.
Ali says the risk that this has a domino effect as well. I mean, could the US also be looking to ban other Chinese tech platforms? I think Temu, for instance, sort of seen as an Amazon competitor that's had a lot of success in the US, comes to mind.
Yeah, and any kind of connection to China has been one that has gotten intense scrutiny. The way this legislation is written is about basically social media companies who are owned or majority owned by a foreign entity. So that scrutiny around that Chinese ownership has come into play because U.S. lawmakers are worried that because of the regulations in China and how they can request data from companies in that domicile, that there could be some kind of risk to Americans. So there is certainly a number of companies. Temu is a great one that comes to mind that might be concerned not only from what the precedent could be set from this current legislation, but also certainly how other countries might react to have America, who is the home to the biggest social media companies that aren't TikTok, now be saying, hey, look, this needs to be a company that's not owned by one of our foreign adversaries and potentially a company that's owned by instead American investors.
Alex, ByteDance also fighting a battle on two fronts. Across the Atlantic, there's trouble in the EU as well. What's going on there? They're staring down the barrel of a fine, right?
They are, and it's not the first time. This is actually the second kind of major moment. TikTok Lite was an app that was launched in both France and Spain within the EU bloc. It rewards users through a point system. And the EU regulator opened a new probe on Monday into whether ByteDance violated its content law because they're worried that this point system might have an addictive effect on users. They have 24 hours to deliver a risk assessment, so we should see potentially some news on this in the coming days. But it's not the first time the EU has gotten involved. The EU has previously announced an investigation under the Digital Services Act around the app's addictive design, around screen time limits, privacy settings, age verification. So all that to say, TikTok is waging battles not just on the American front, but certainly in other domiciles where there are either privacy legislation already in place or similar concerns about its ownership and its connection to the Chinese government.
All right, tech reporter Alex Barinka there on the difficulties currently being faced by ByteDance and TikTok. And on the topic of difficulties, we've been hearing plenty about them from Tesla. Let's take a look at how Tesla closed in the US. Not another great day for that stock as we await what is expected to be a fairly brutal earnings report. We'll get more on that in just a moment. But it's an ebbing tide that sinks all boats. In the EV space, we've got VinFast down by about 3.5% as well. Worth noting, though, the performance of General Motors and Ford, the internal combustion engine, not quite ready to join the horse and the steam engine on history's scrap heap. Still seems to be a place for conventional power vehicles as well. Both those stocks, GM and Ford, also going to be reporting earnings this week. Having a pretty good day. Ford up by more than 6%. Well, for more on the Tesla story, let's bring in our global business editor, Peter Verco. And Peter, we are eagerly counting down to this Tesla earnings report. It's going to be a very, very interesting day. What are analysts looking for?
Yeah, obviously there's expectations that earnings are going to fall. We've already seen that big 8.5% drop in vehicle deliveries in the first quarter year on year. So the numbers aren't expected to be good. But I think what investors and analysts are looking for goes beyond the numbers this time, and they're really looking for some coherent strategy from Tesla and whether Musk is going to take the concerns seriously. We've seen on these previous earnings calls that Musk can be kind of flippant or disinterested. He can sort of be dismissive of questions, sort of treat the whole thing as a chore. He'd rather be doing something else. And I think in previous times, investors have sort of excused that a little bit when Tesla's flying. You know, sales up 50% year on year, the stock's surging to record highs, that sort of stuff. This time it's a bit different. I think there's going to be a real focus on Tesla and on Musk in particular to outline that coherent strategy. You know, as long-time Tesla watcher Dan Ives said, who's going to be the adult in the room this time? We saw that chaos continue on Monday in the US when Tesla dismissed its about 40 employees in its marketing team. It was only formed about a year ago, and then Musk dissed their work on X, formerly Twitter, saying the ads were too generic and they could have been any car. So we just seem to be getting like these shifts in strategy made at the whims of Musk, who we know is a pretty mercurial character at best. He has seemed to now stake the company's growth outlook on a robo-taxi that he says will be unveiled in August. So there'll really need to be clarity on that, and whether that's going to come at the expense of what was widely anticipated to be a more affordable mass market car around the $25,000 mark. And we know that Tesla hasn't nailed full self-driving or autonomous driving yet. What it calls full self-driving still needs constant human supervision.
Mm-hmm.
Peter, we've seen Tesla resorting to sort of a familiar strategy, and that's price cuts to try and boost sales. But how much further can it continue to do that? I mean, there's some reporting out, for instance, Evercore ISI is saying that price cuts in China, for instance, could cost it the entirety of its operating profit there.
Yeah, that was a really interesting report that came out yesterday after we saw the latest round of price cuts on the weekend. And it does seem to have been Tesla's strategy, you know, sales down, cut prices, sales down, cut prices. But what's really happening now, you know, particularly in China, it's faced with this whole suite of new competitors from, you know, BYD to even Xiaomi, which has unveiled its first EV. And these are cars that Chinese consumers want. They're across all price points. They're really sort of tech heavy and all sorts of cool gadgets like, you know, convert into beds. They have roll-out kitchens and all this kind of stuff. You know, Tesla really just relies on its Model 3 and its Model Y for the bulk of its sales, not just in China, but globally. And without, say, that mass market so-called Model 2 $25,000 car, how are they going to fill that growth hole? They can't just keep cutting prices.
That was our global business editor, Peter Verco, as we look ahead to those very crucial earnings. And we'll actually have more analysis on them coming up this hour. The outlook for the firm in China in focus with the CEO of JL Warren Capital. That's just ahead.
You are watching Daybreak Australia. Here's the latest in geopolitics. The Israeli military's intelligence chief has quit for failing to prevent the October 7 invasion by Hamas. Aharon Haliva is the first senior Israeli official to step down over the assault that killed about 1,200 people. He accepted blame shortly after the Hamas attacks, but stayed in his role as Israel launched its war in Gaza. The EU has agreed to impose new sanctions on Iran over its attack on Israel. The deal will further expand restrictions already imposed for supplying Russia with drones. The measures also target weapons transfers to Iranian proxies in the Middle East, including Hezbollah. Countries including Germany and Sweden are pushing to add Iran's Islamic Revolutionary Guard Corps to the EU's terrorism list. President Biden has told his Ukrainian counterpart the US will move quickly to deliver weapons if the Senate votes this week to approve an aid package. In a phone call, Biden told Volodymyr Zelensky the US aims to swiftly ship the battlefield and air defense equipment. Meanwhile, the UK is sending more missiles to Ukraine, including long-range guided weapons and a package worth $620 million. All right, we have plenty more to come on Daybreak Australia. Stay with us. This is Bloomberg.
This is Daybreak Asia, just taking a quick check on what we're seeing in the bond space this morning. A little bit of a retreat for yields in the Antipodean, so very much tracking what came through with Treasuries overnight in the session. It is that changing expectation around tensions in the Middle East. They do appear contained for now. And also, bond traders are looking ahead to a record auction for signals perhaps that 5% yield is the peak, but certainly that is going to be a key test and a very tricky week as well, because we're looking at the market absorbing nearly $185 billion calendar of 2, 5 and 7 year note sales. So certainly something we'll be tracking very closely here, Paul.
Well, let's take a look at some of the morning calls ahead of the Asia trading day. BlackRock's Rick Reeder says bond investors are facing a painful run-up in yields may soon find relief. The firm's CIO of global fixed income sees 2 rate cuts by the Fed this year as inflation moderates in the months ahead. For now, he says BlackRock has cut its own interest rate exposure, weighting investments more towards shorter maturities.
I think the beauty of this for an investor going into it is we're trying to manage our interest rate exposure, and if we think, which I think will be the case this year, we're going to get to a place where we anticipate the data improving, and I do think over the next month or so you're going to get better inflation data.
Meanwhile, JP Morgan's Marko Kolonovic says the 3-week rout in US equities, it's not done yet. The bank's chief market strategist says rising bond yields, elevated oil prices and high stock market concentration are among a lengthy list of reasons. Kolonovic adds he's concerned about complacency in equity valuations, inflation, a further repricing of rate cut expectations and overall rosy profit outlooks. And ahead of this week's earnings, UBS Group's Jonathan Golub is cutting their sector recommendation on the big 6 tech stocks from neutral from overweight. Golub says earnings momentum is turning negative after a surge in profit growth. UBS calculates that growth in earnings per share of the big 6 is expected to slow down to 42% in the first quarter, and that's down from 68% growth in the previous period. Bell.
Well, Paul, of course, focus on earnings, kicking off with Tesla and taking a look at this chart here. The slide that we've seen in Tesla's stock over the past 5 sessions are down nearly 10%, but the losses this year totaling more than 40% of a drop. The EV maker, of course, we know is set to report its first quarter earnings, and price cuts very much the focus as well, the ramifications of those. And we had more being announced over the weekend in countries, including in China, where EV buyers, of course, are also awaiting a stimulus program that could encourage or include incentives that aim to encourage businesses and households to adopt cleaner technologies. So let's discuss more of this with Junheng Li. She's founder and CEO at JL Warren Capital. And I'm interested for your views, Junheng. We can get to Beijing's sort of trade-in plan in just a moment, but these price cuts in China, are they going to be something that's really substantial enough to try and boost demand there?
In the case of Tesla, probably not, because I think the core issue with Tesla not selling well in China is its aging look design. Tesla has not had a new product for the last 3-4 years. Model 3 came to the market in 2017, Model Y 2020. But meanwhile, there's many made in China homegrown brands. Latest has been Xiaomi, and a while ago, a few months ago, Huawei car, and before that, BYD, a number of models, and Zeekr, GD, Zeekr. Cars had a few successful models, all targeting at a price range of at around 250,000 RMB. So this price range has become extremely competitive, and Tesla is not able to launch any new product in the last few years. Definitely slow down its momentum in China.
Yeah, I was actually in China, mainland China, over the weekend, and I was just astonished at the number of different EV makes over there on mainland China. But the price cuts then, do you think Tesla's sort of shooting itself in the foot?
Well, I mean, it doesn't really have alternatives. Because everyone else is cutting price. And in fact, Tesla has been doing promotion consistently over the past 6 months, either through the insurance rebate or zero financing. And it actually raised the Model Y price by a couple of thousand renminbi effectively on April 1st, but then only 2 weeks later, it slashed price again. So, I mean, you see this as a general pattern, not just in China, but also in the US as well. Not only just on hardware, but on software as well. FSD subscription was at $199 a few weeks ago, and adoption was poor, so they immediately cut the price by half. So I think this is going to be a really tough year for Tesla. I mean, I think the problem can be just the total addressable market isn't as big as people had thought. It does really well in particular markets like California and like China, where there's a lot of administrative incentives. But when that slows, and when the competition catches up, the momentum just automatically, very naturally comes down.
Jungheng, in your analysis, you point to an oversupply of vehicles that are coming out of Tesla's Gigafactory in Shanghai. Even with price cuts, is China's market able to soak all that up, or are there other markets in the region that might have to do that?
I think when Elon Musk decided to build and expand GF3 outside of Shanghai in 2018, you had this in mind that made in China cars can be exported to certain markets, particularly in Europe. But over the past 5 years, we see escalation in geopolitics tension. So obviously, the access to U.S. market is not possible, and potentially in the future, India market is not quite possible. And then right now, Europe is the largest export destination for made in China cars, but that can change going forward with tariffs or maybe some outright ban in the future if the geopolitics continue to escalate. So in that sense, it's possible that we see this oversupply is not at its worst yet. It could go from bad to worse in the next couple of years. So right now, 50% of the cars made in China are for domestic deliveries, and 50% were exported away in 2023. But the European demand is muted as well. So that's why we see 25% year-over-year decline in GF3 production. And right now they're making about 2,000 cars a day versus its capacity at 3,000 cars a day. So it's at about like 65% utilization for capacity utilization. So that's going to it's going to do some damage to its gross margin.
Well, I've been hearing from Elon Musk over the past few days. He's increasingly going all in on full self-driving, on robo-taxis as well. But in terms of China, what's the consumer demand like for those sorts of products, and what's the regulatory environment like as well?
I think FSD is primarily a U.S. story because that requires access to map data. And map data in China, I mean, I believe they use a Baidu map, but they have access to Baidu map, but they don't have access to the data behind the map. So that's a handicap to number one. Number two, all the data onshore data cannot leave China. So they have to process and train the data onshore. But obviously, the Nvidia GPU hardware and software have this export ban leaving US. So that's a handicap number two. So I think FSD is not a China-centric story. I don't think consumer demand that, not especially when you have to pay $8,000 for that subscription. So, and on the US side, if you read the stories out there, and there are lots of them, and lots of those stories on detailing their journey on a Tesla Drive using FSD, are very accurate and very good, both positive and negative. So the picture is rather mixed. But I just think it's too early to ask people to pay for a product that still requires, a pretty frequent human intervention and still requires hands on the wheel. But most importantly, I don't believe that there's a demand for autonomous driving for a short commute of roughly an average of 20 minutes each way from home to work. I mean, I just don't think the demand is there even in the US.
And Jin Hong, I'm interested what you're seeing more broadly in terms of luxury demand in China. We have seen sort of a pickup perhaps, but spending levels do seem to be a little bit lower still.
Yeah, consumption dipped again after the Chinese New Year in the middle of February. We are pretty diligent with our store surveys, and what we see is the first 2 months of the year, the consumption kind of came back a little bit, but then immediately after the Chinese New Year, it dipped again. Obviously, each brand has its own stories. There are tier one luxury brands such as Hermes and the Louis Vuitton and the Chanel. They can dial up or down the supply to manipulate the demand and the outcome, the financial outcome. But when it comes to sort of a secondary luxury brand such as Gucci, it's a little bit tough because in the case of Gucci specifically, they have this like a change of designer, and the new designer is supposed to launch its debut that's going to hit the stores globally in Q2 and Q3. But in a down market, when the economy is weak, what we see is the receptiveness and the reception of newness is rather muted. So in a tough economy, people embrace or clinch towards the old design, the logo, and the leather fashion that preserves value, as opposed to the fresh new design. So I think that's the headwind the brand needs to embrace in the next few quarters.
All right, Junheng Lee, founder and CEO of JL Warren Capital. Thank you so much for joining us with your insights. Still to come, US climate advisor John Podesta weighs in on China's overcapacity in green tech. A look at how trade tensions are playing into the energy transition up next. This is Bloomberg. The senior White House climate advisor says the US needs to ramp up the speed and scale of its shift away from fossil fuels. Speaking at the Bloomberg NEF Summit New York, John Podesta also joined the chorus of complaint coming from Washington about China's overcapacity.
We're concerned about overcapacity in China across the so-called green technologies, batteries, electric vehicles, the solar supply chain. Particularly the shift of the economic focus of Beijing has been on trying to get out of the stagnation they were in by over-investing in capacity in some of these technologies. But that is not good for the United States, it's not good for workers, and it's not good for the world, because we need a level, competitive playing field across the globe so that everybody has a fair chance to compete, build the products that are necessary. I think American auto companies and auto workers can compete with anybody across the globe. So we're going to do what we need to do to protect the investments we're making as we're decarbonizing. The first goal we have is to cut our emissions in half by 2030. That's what the IRA was all about. It was to invest in these new technologies, to spur innovation, and we're not going to let those be undercut by unfair trade practices.
But do tariffs hurt climate change? In the sense that you wake up every day and you think about decarbonizing.
I think what we need to do is to have a system that's, and I think, by the way, I'm now traveling around the world, and people were first critical of the IRA. And I think what's happened, particularly with our partners and allies in Europe, in Japan, in Korea, and other places, is they've responded by saying, this investment-led strategy is a smart strategy. It helps spread the benefits of green energy across communities. We've been very mindful of trying to ensure that every community, including traditional energy communities, feel the positive effects of the investments that we're making. We're seeing the emissions profile and emissions reductions happening, and we need to protect that overall effort, and we'll do what we need to do that.
That was the White House Senior Climate Advisor John Podesta with Bloomberg's Anne-Marie Hordern. And staying on those efforts to reduce emissions, Bloomberg NEF's latest annual assessment shows that G20 countries have made limited progress on decarbonisation, improving their average score from last year by just 1 percentage point. That's fanning worries among consumers, industry and investors. Let's bring in BNEF Head of APAC Research, Ali Azadi, for more. And Ali, why is it that the scores aren't improving so much?
So one of the main challenges is policy uncertainty. Even the Inflation Reduction Act, which is now seen as a success, if you look at the process to getting that act passed, it created a lot of policy uncertainty throughout that process. So overall, over the last couple of years, we've seen policies around decarbonization face a lot of uncertainties. And in some cases, we have seen actually G20 members roll back initial measures that they have put in place. In parallel, we have not seen G20 members fulfill their commitments to reduce incentives for fossil fuels. Annually, G20 members still spend hundreds of billions of dollars subsidizing fossil fuels, which is, of course, not helping with emission reduction.
Ali, the Asia-Pacific members of the G20 are largely clustered around the middle of this ranking. So what's driving the scores for Japan, Korea, Australia, India and Indonesia as well?
So indeed, as you pointed out, if you look at the APEC members of G20 compared to the European members, they do relatively worse. Part of this is a reflection that the European members have had longer, consistent measures towards decarbonization, particularly when it comes to their power sectors. So on average, they score better on that front. They also all have the European members have very stringent, robust carbon pricing mechanism in place. Across Asia-Pacific, while markets such as China and South Korea do have national emission trading schemes, still the level of carbon pricing in these countries is not enough to drive decarbonization. Overall, among the APAC members, we see Japan and Korea do relatively better, partly because they have policies across all sectors, so not just for power and road transport, but looking at areas such as industry as well as circular economy. But still, overall, when we compare them to European members, they're lagging behind.
And so how would APAC countries then lift their scores in turn? What are the best sort of policies to do that?
So there are two fundamental areas. One, clean power is really important, and while you've seen improvements, particularly in markets such as China and India, still the power market design of APAC countries compared to European members is not in a way that provides incentives for acceleration of renewable deployment. Where those power market designs have improved, for example, China, India, as well as Australia, we have seen deployment accelerate. But if you look at, for example, Japan and Korea, we've seen annual renewable deployment actually decelerate in recent years because of the lack of the right policy market design. The other area, as I mentioned earlier, is around carbon pricing. So when we look at the level of pricing of emissions today across APAC regions, the pricing levels are simply too low or actually non-existent. Without pricing the emissions, we will not see the accelerated trend towards decarbonization, particularly in hard-to-abate sectors.
All right, Bloomberg NEF Head of APAC Research, Ali Azadi there. Still to come, fresh signs of stress emerging in Korea's shadow banking sector. Why it's being seen as a weak link in a $63 trillion chain. That story up next. This is Bloomberg.
South Korea is emerging as a weak link in the world of shadow banking, with its real estate exposure quadrupling over the past decade to more than $670 billion. For more, let's bring in our Asia credit editor, Finbar Flynn. And Finbar, this is something that's certainly spooking a lot of global investors. But what's the root problem of the stress in Korea exactly?
Good morning. Yes, indeed. So the root problem goes back to that flush of cheap cash that was around the globe after the global financial crisis. So in Korea, as in many other parts of the world, low interest rates near zero or less, that cash had to go somewhere. And it went in Korea in many respects in these more riskier projects in and outside of Seoul. And it's come a little bit undone as rates in Korea, like much of the world, have gone up.
So how serious are these issues and what are market participants expecting here?
So to date, the government has done a pretty good job of keeping stuff intact. But the worry is that in the second half, now that elections are out of the way, that it'll have to take a stricter sort of stance on all of these issues. So the baseline is that people are hoping, expecting a soft landing, but the seriousness of the situation can't be underestimated, because this could force the Bank of Korea to cut its rates more than it would wish, and it could also impinge on growth in the second half. So we have to keep an eye out.
We've seen policymakers managing to sort of stem the contagion risk so far, but would this be the case this time around? And if not, what are the sort of milestones to look out for in particular?
So we have one coming up actually this month, a company called Taeyong. Surprised markets at the end of last year when it said it had to restructure its debt. So there's a vote at the end of this month for banks, including KDB, a state lender, to sign off to actually give their approval to this restructuring. And our reporting has shown that 50% of the debt on Taeyong's books there may be converted into equity in a huge equity for debt swap. But we need to keep an eye out that that goes all to the plan, to be honest.
All right, Finbar, thanks for joining us. That's our Asia Credit Editor, Finbar Flynn there. Okay, here are some of the stocks that we're going to be watching when trade opens in Korea, Japan and Australia. Just a few minutes away now. Keep an eye on Asian Tesla suppliers. Of course, the EV maker is set to report its first quarter results after cutting the price of its cars in key markets, including China. Woodside Energy is going to be in focus as well, and this is after one of Australia's largest pension funds, Aware Super, voted against its climate plan and re-election of Chairman Richard Goyder. Aussie miners might move as well, gold taking a tumble, haven demand easing, along with easing tensions in the Middle East. Those market opens in Sydney, Seoul and Tokyo next. This is Bloomberg.